Good morning. This is Ruggiero Lo Monaco, Head of Real Estate Funds at Rasmala Investment Bank. Uh, Today we are going to talk about bear rates on UK long income REITs. Today is the 26th of November. It's 2 p.m. in Dubai. So this week we had possibly a bear raid on a UK REIT called Home REIT. And bear raid is basically when a short seller forcefully builds a short position in a stock and then spreads rumors, informations to cause that stock to collapse, and then they cover their position. The practice, obviously, it's illegal, but if it is indeed the short seller has uncovered malpractices, well, then it's not illegal at all. Now, I have seen this happening a couple of times already in the sector that I cover. So I thought to give some detailed look at this phenomenon and see whether indeed for us there is a way of benefiting from the mayhem caused by these short sellers. So first of all, here I have identified sorry, a number of long income REITs, Hashura PLC and Primary Healthcare Properties. They are active in GP surgeries. LXI REIT is a diversified REIT. It's active in various sectors like hotels, amusement parks, and it's the result of a recent merger with Secure Income REIT. Civitas Social Housing and Triple Point Social Housing. They are in the supported living sector, which is providing housing to people with physical or mental disabilities. REIT, which just mentioned, provides houses for the homeless, and Supermarket Income REIT owns long income supermarkets. So what do they have in common, these REITs? They have in common that, like the US trouble net leases, they own properties with very long leases, typically 25 years, which are index linked. And another thing that they have in common is that the assets, the properties that they own, could be classified as alternative. So an alternative property is alternative to what? Clearly to offices and shopping centers. Traditional retail, and although in the UK it's not really a mainstream sector, but you would say residential, multifamily, and industrial and logistics. So these are the traditional sectors. The alternatives is everything else. Now, because of the alternative nature of these properties, there is a certain degree of uncertainty in valuing the property itself, because these properties don't trade very frequently in the market. So there are a lot of comparables to price these properties. So a lot of value is in the lease itself. And with a 25-year lease, clearly the bulk of the value of the property is in the lease itself. That's the reason why the short sellers, typically US hedge funds, have taken a keen interest into the UK long income sector to try to uncover situations where the REIT is showing a certain value of their portfolio and a certain income, and which is fundamentally different from what is the real value of the properties. And they do so by undertaking very detailed and thorough investigations of these portfolios, which end up being summarized in a paper which is published soon after the REIT has built its own short position, causing the price of these REITs to fall, at which point the REIT very quickly covers their shorts. They acquire all the shares that have been dumped by investors who are panicking and scared about the information. So the REIT typically closes their position, and these stocks end up languishing. Now, we have seen this happening some few months ago with another REIT called the Civitas Social Housing, where a REIT published a report after having built a short position, and we also are seeing some short positions being built in REITs like Supermarket Income REIT. Okay, although here no short seller has come out with any paper or any research questioning the value of this REIT, but it's worth monitoring the building up of these short positions. Now, specifically on the social housing part, there have been situations where the sponsors of these REITs, or people, or not so much a sponsor, all the parties involved into these REITs might have indeed colluded to inflate the value of the properties which are sold to the REIT. And how this happens, or this has happened in certain cases. For example, a developer acquires a number of properties, residences. It leases refurbish them, some light refurbishment. It leases those properties to a charitable institution, a housing association, okay, for 25 years at a relatively high lease, and a situation which he is also a housing association where he might be a trustee. Okay, so there is a conflict of interest there. And then the property with the long-term lease to the housing association is sold to a REIT. So what the hedge funds, the American hedge funds do, they go and actually dig out the various leases and properties and try to find evidence of where there could have been malpractice. They list them, and this is basically what causes the mayhem in the market. But the reality is that after they have caused this mayhem and they have basically created doubt in the mind of the investors about the viability of these REITs, they just leave. Okay, and but they create damage because this REIT starts trading a substantial discount. So to the published NAV, their auditors get scared that they have audited financials which on the basis of valuations which might not be accurate. So it really creates a serious problem for these REITs to operate. But at the same time, these REITs do continue to have income supported by long leases. In many cases, like in the area of social housing, there are governments, the local governments are actually paying for this or subsidizing these leases through transfers to the housing associations. So there is actually a form of government backing behind this income. So to go and buy these positions soon after a bear raid might not actually be a bad strategy at all. So first of all, before we going through the various REITs, I wanted to recap briefly on where we stand on inflation and interest rates in the UK. Interest rates have come down a little bit since 30th of September. Okay, so the curve is inverted. So the 1-year rate it's much higher than the 50-year rate. The 50-year rate it's below 3%. That really tells you what the market think about the long-term growth and potential of this advanced economy. Inflation is very much expected to stay above the interest rate. So there is negative real rates again in the UK, which means that if an investor wants to preserve the value, the purchasing price value, the purchasing power of its money, it really needs to invest to generate a premium over the interest rates, and certainly matching the inflation. So what I would say is that real estate, equities, these are really the asset classes that can really generate the 2 or 3% above the interest rates, which can compensate for the erosion to capital of inflation. Now, the second chart I wanted to show is this very, very long history of the FTSE EPRA Rate UK index, going back to the 90s. This is priced in GBP. The reality is that if you priced it in US dollar, it would be even worse outcome than this, because over this period the pound has depreciated versus the US dollar. So going to the 90s, you can see that basically all the way to 2003, the market really wasn't doing, the real estate market as measured by the REIT wasn't doing much. These interest rates went out post the dot-com bubble. There was a real estate bubble, which brought up by 241% the value of these REITs. That was then followed by a 78% drop in valuation, which actually cancelled all the upside and indeed delivered the return, negative return over the previous probably 20 years, 18 years. But then in 2009, there was a big recovery, interest rate went down, there was a big positive spread, all the leverage investors went in, the market recovered very strongly, 179%, there was a 17% per annum. Everybody that bought properties in 2009, 10, 11 really seemed to be a genius. Until Brexit in 2016, and then the market has really not done much there until the beginning of this year, when there was a final stroke. So that basically brought us back to 1990 in terms of this value. Now, bear in mind that this REIT has a large component of office and retail. Alternative sectors like logistics have done, the logistics, the e-commerce, for e-commerce and other sectors, alternative sectors, including long income, actually have done better, although they might not have had such a long history. That's the reason why it's important. It's important when investing in the UK to pay attention to these alternative sectors and to the long income sector. Now, going to the details of the various REITs that I selected. For the 7 REITs, you will. I've basically provided these 3 sets of this information. The share price, as long as I could go back, the dividend history, and the short interest, which I managed to get from shorttracker.co.uk. So it's freely available. So for Home REIT, you can see that it was launched not long ago, okay, and it had been doing very well. It was issuing, has been issuing equity regularly. It even managed to secure a 15-year lease, a loan from Scottish Mortgage at a very attractive return of 2 point something percent. So it's hard to see. And then on the asset side, I mean, they were having basically 25-year leases with a handful of housing associations which provide shelter for really vulnerable people like homeless people. So on paper, it's difficult to see how this REIT couldn't make money because their dividend yield is something like 5.6%. They have a 15 years funding fixed rate secured at 2.3, 2.4%. So they have a very, very healthy spread. But the bears, they were not satisfied. They started building a short position, which caused the price to drop from 100 and, I mean, let's say from 90, okay, where it had fallen in line with the market, to at some point it was trading even at 50. Okay, there has been a short recovery soon after, and now it's yesterday closed at 59.7. So what that leaves the REIT leaves with a dividend yield at this level of 6.9%. Is this sustainable? Is this secure? Well, it's at the moment it's high just because it's a reflection of the fall of the share price. Over the weekend, the company announced that they will not publish their annual results on Monday as they were expected. They were audited, they were ready to go, but because of this very, very serious accusation of malpractice, the auditors have requested to look again at the numbers. The investment manager, Alvarium Securities, is quite. I contacted them, I spoke to them, I said, look, this is all unfounded allegations, it's just market manipulation. We will issue a rebuttal, very detailed rebuttal, but of course we need to have the auditors review everything. Bear in mind also this portfolio was valued by Knight Frank, so there is also an issue there. And I read the report. Frankly, there were some things written in the report that I said, wow, they really seem strange. I mean, they were referring to a property which was bought for, I don't know, £170,000 and valued at £13 million. I mean, I doubt, really seriously doubt that a valuer would have missed something of that magnitude. So it looks like a lot of information has just been thrown into this report just to create mayhem. I mean, some collusion might have happened. I mean, we have seen it in the past. Collusion between the developers, the housing associations. I doubt that the fund manager was involved into this, but in some cases it does happen that the fund managers provide financing to the tenants so that the tenants can pay rent. And this has happened in some cases, but it's eventually when the fund managers are pressed, they refer to standard market practices to get a tenant in a property, and not necessarily point to the inability of the tenant to pay their rents. Anyway, we will see the next few days how this settles, whether this share price will remain at these levels, or maybe will recover a little bit at $70 and just stay there. So the other REIT where exactly the same thing happened is Civital Social Housing. In this case, they provide homes for another subset of vulnerable people. So these are people with mental or physical disabilities. So these homes are customized. There might be a medical equip on the premises. So the value of these properties tend to really diverge from the value of the asset on a standalone basis. In the cases of home REIT, I mean, when I spoke to them, they said that actually the rent paid by the housing association is lower than the rent that we would be able to achieve to if we were to let this property in the market. So we have actually quite a buffer. In the case of the supported living, indeed there is a 20-30%, let's call it a difference, a positive difference between the value of the property and the leased to housing association and the value of the property on a standalone basis. So it's important really to spend time to understand the viability of the housing association and whether there is a risk of a collapse of the housing association. Clearly, the government will not let vulnerable people being evicted. They will step in, or they will have someone step in. But there will be a reset of the rent, which could trigger a downward adjustment of the valuation of these assets. But again, here we have now an asset that purely as a result of this attack, and you can see that the short has been built and then zero, then now has been zero again. So the short sellers, they make a big noise, they raise lots of questions, then they close their position and they move on. They don't stay. Actually, they are not like activist investors. And of course, they play on the fact that these are relatively illiquid REITs, which very easy to be moved. But as it stands, it's a 9.07 type of yield. Similar to Civitas, this housing REIT. Here there has not been a specific bear raid. I mean, there has not been any short seller coming up. They build some short position, but the share price fell anyway in sympathy with social housing. So with Civitas social housing. It looks like investors have said, well, if this was happening at Civitas, maybe it's happening also at Triple Point. Now, moving to the GP surgeries, I have taken here Assura PLC. This is a REIT, or better, was to be a property company before being a REIT, which really benefited a lot of the. I mean, had a big run during the real estate bubble, then really suffered a lot. It was restructured, and indeed, if you actually look at the performance since 2009, 2010, it's really done well. Okay, they really focused on GP surgeries. They really became very strong, very specialized in this sector. But the share price has been quite weak, and you can see that some short sellers have been building their position. It's difficult to say whether they were doing that, I mean, maybe some part of some kind of a pair trade, maybe going long one stock and short this to try to exploit some relative value opportunities, or maybe because they were building some a case and they found not a very compelling story, and then they just exited. Here, what could have been the story? I mean, GP surgeries again is a very specialist asset, and it is leased for 20-25 years to the general practitioner. General practitioner receives a refund from the NHS of its rent. So the story here that you hear is that this is basically government-backed rents, but in reality, the general practitioners are just individuals. So they are not really representing the government. So that probably was the story that some short seller wanted to build, but it didn't go anywhere, and they just left the stock now languishing at 56.6 with an attractive dividend yield of 5.36. This is clearly higher than interest rates, but there is a growth story here. There is a very you can see that from 2009-10 really the stock has been able to increase the dividends, and the reason why they are able to do, because they are able to renegotiate the leases on their with their general practitioners based on the construction cost of comparable properties. So this is not index inflation linked, but it's linked to the construction cost. And as you know, right now the construction cost of the properties are going up, so they have a very strong argument to increase the leases. Exactly a similar situation with primary health properties. They also have a very good history of delivering a nice yield of 5.6% and growing at 4-5% per annum. So on this basis, you can easily see this property, this security delivering a 9-10% per annum type of total return. Similar, they focus on GP surgeries, and you can see that the short interest has been building up on this, and there are a number of hedge funds building short positions. And the share price, share price has gone down, but here primarily because the whole market has gone down. So they are also quite large. So it may well be that the short positions were just made as a result of just a macro trade. LXI REIT, we discussed it. Now there is no short position at the moment, but one had been built and closed. Here, what could be the story? The story, it's very alternative assets. They have the Merlin entertainment parks, amusement parks. So assets very difficult to price. They have travel lodge hotels, supermarkets. So who knows? Maybe some hedge funds might want to try to build a story, but nothing at the moment on this REIT. And here is a supermarket income REIT. Okay, so we have seen now GLG partners, and they have been building this short position, bigger and bigger. They really have caused the selling pressure has really caused the REIT to reprice. We know that supermarkets have repriced quite a bit. There were some supermarkets trading at just above 3%. Now, according to CBRE, typically is a 5.5, 5.6%. The net initial yield of a supermarket. We don't know. It's a quite concentrated portfolio. There are Asda Supermarket, Morrison, Tesco, and Sainsbury. So who knows what really these hedge funds are thinking. So in conclusion, what I would like to say is that these activities seem to create essentially buying opportunities for long-term investors. They depress these short sellers come in, they depress the prices, and it might take years for these prices to recover. Underlying, we have properties which generate long income, and after the share prices collapse, the yield are quite attractive, and these are rents linked to inflation, so there is an element of growth there as well. So again, it's a theme. It's a theme to allocate 5-10% of a real estate portfolio to this. Obviously, always bear in mind the effect of that currency can have on this asset class. And if you have been following my video blogs, right now we are relatively positive on sterling, so we actually think that the UK real estate allocation should be unhedged. So I hope you have found this update interesting. As usual, if you want to discuss in more details with me, feel free to reach me. Thank you, and bye-bye.